Okay, we'll get started in just about a minute. When we get started, I'm going to go into full slide screen mode. So just give me 1 second. I'm going to go into full slide screen mode, so I won't be able to see your questions, but we'll take certain breaks where we're going to flip back to the box so I can check to see if there's any questions being listed. So don't hesitate to post your questions because I will try to get back to them as much as I can. All right, so with that, let me go into full screen mode. What we're going to talk about today is we're going to talk about how to trade the Australian dollar. Now, every single currency has unique characteristics, which is why I think it's important to dedicate some time to learning a little bit about them and learning exactly what is important to know with regards to trading each currency. So the Australian dollar is no exception. The Australian dollar is moving quite a bit today, and I would even say that it is the biggest market mover in terms of the currencies with the dollar as a part of the pair. So it's the largest major mover for today. And there's a good chance that we could see more volatility in the Australian dollar this week. So as a result, it'll be quite important to pay attention to why the Australian dollar is moving. But before I begin, I'm obliged to show you this disclaimer. And basically, this disclaimer indicates that trading currencies can be risky. So it's important to know, how much risk you have in the market at any point in time, because any leveraged product can magnify your losses as well as your profits. So with that, let's go ahead and get into the meat of the presentation. So what we're going to do is we're going to talk a little bit about the Australian dollar itself, the nuances of trading the Australian dollar. Then we're going to talk a little bit about some key facts and stats on the Australian economy, because that plays a very big role in how the Australian dollar is trading. And then we're going to go into the importance of China and how the slowdown in Chinese growth affects Australia. We're going to take a look at how the Australian economy has been performing over the past month. Take a look a little bit about what the central bank has been saying. And then we're going to look at a trading strategy that can be used in the Australian dollar. So what you need to know about the Australian dollar. Well, the Australian dollar is a pretty actively traded currency, but is not as nearly as liquid as the euro and the British pound. And because of that, there is some unique implications that this lack of liquidity has for the Australian dollar. First and foremost, it basically means that we tend to have more jumpy and erratic price action in the Aussie. It also means that we can have periods of time where the spread in the Australian dollar can get a little bit wider. So it really depends upon the time of day that we're trading, as well as the type of environment that we're trading in. The Australian dollar is the sixth most actively traded currency in the world, so it trails behind the euro dollar, the pound dollar, dollar yen, even dollar Swiss, and other major currencies. Australia is the 13th largest economy in the world, and it's home to the 8th largest stock market. So there is quite a bit of interest in the Australian markets, in the Australian economy. But what we have to bear in mind is that it is the 8th largest stock market, which means that it's not extremely large, it's not extremely small. So there's only so much capacity that the Australian markets can take before you actually see some larger, illiquid movements in both equities and currencies. Now, even though it's the world's 13th largest economy and is home to the eighth largest stock market, last year Australia was the fastest growing advanced economy. Now, because it was the fastest growing advanced economy, the Australian dollar held up pretty well in 2011, particularly in the beginning of the year. It basically, rose above parity, rose to a high of 1.1080 in July. Did fall off a bit after that, but it still ended the year above parity. The Australian dollar gets a tremendous amount of interest because it has the highest interest rate among the G20 currencies that we trade. So in an environment where, we had some periods of time where investors felt comfortable enough to take on some risk, the Australian dollar did find some demand in the beginning of 2012 because even though Australia had some indications of slower growth, the Australian dollar still offered a high enough interest rate that we still saw investors around the world basically move some of their money into Aussie dollars. So that's an important fact to remember, which is that despite what may come in terms of what the Reserve Bank may do over the next month, over the next few months, Australia still offers a relatively high interest rate, and so that could temper any major decline in the Aussie dollar. The Australian dollar currency pair, as number 6 says, tends to have a wider spread than the euro dollar and pound dollar. So because it has a wider spread, it can be looked at as a slightly riskier currency to trade. And because it's a riskier currency to trade, on days when we have quote-unquote a risk-on move, when stocks are rising strongly and the investors are optimistic, that tends to be very positive for the Australian dollar. But unfortunately, when markets are somewhat nervous, we tend to have a significant sell-off in the Australian dollar. So that can explain why we've seen such a sharp decline in the Aussie dollar today. Now, one of the interesting things about trading the Australian dollar is that it's most active during the time zone of Asia going into Europe. So Australian data tends to be released in the evening in the U.S., which is anywhere between 7:30 to 10:30 p.m. New York time. So that's when we tend to see a little bit of volatility in the Australian dollar, and that volatility tends to carry through into the early European hours, and sometimes even into the New York Open. But usually that's when we see the most interesting and most active trading in the Australian dollar. So for those of you that are keen on trading the Aussie dollar, then the Asia-European overlap may be an attractive time to trade. And what you'll find about the Australian dollar is that there's a relatively unique behavior in the currency, in that it will trend intraday for a couple of hours, and then it will range. So this is something that's pretty important to pay attention to, because you can have a period of time where you have the currency pair, rally, 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 and then do nothing for a couple of hours. Or the reverse, where it can sell off, sell off, sell off, and then do nothing for a couple of hours. It's a very common type of behavior that we see in the Australian dollar. Even if you look at the price action in the Aussie dollar today, much of the sell-off that we saw in the Aussie dollar was pretty much during the Asian and then into Europe. And from, I would say, about 5 a.m. till now, we haven't seen too much volatility in the Aussie dollar. And once again, it's very common with regards to how the Aussie dollar trades. And number 10 is the last thing, but one of the most important things to remember, which is that Australia has one of the highest interest rates among the G20. So some key stats on the Australian economy. Well, Australian GDP is about $1.57 trillion. So that's, a pretty good-sized economy for Australia, but you can compare that to U.S. GDP, which is about $14.5 trillion. So the Australian economy is only about a tenth of the size of the U.S. economy. Population-wise, there's about 22 million people that live in Australia, which is less people than the population in Texas. So Texas has a larger population than Australia. Yet the unemployment rate in Australia is quite low, 5.2%, and the GDP per capita is pretty high. Australia actually has 8 times more adults earning over $100,000 than the global average. So what this tells you is that Australia is a relatively rich economy. And even though they have a very small population, they generate, a pretty good amount of GDP growth per population. At the end of the day, however, because they are a small country and a small economy, they can be very sensitive to global development. Australia is an export-dependent economy, and their main exports are coal and iron ore. Their main exporting partners are China and Japan, where China takes about 25% of their exports, Japan takes about 19% of their exports, and South Korea takes about 9%. The U.S., on the other hand, only takes about 4%. They import quite a bit, though, but their import is concentrated in machinery, computers, so basically technology, and oil. And once again, China is their leading import partner, followed by Japan. And the U.S. doesn't even make this list. So this tells you that China is an extremely large trading partner for Australia. And so they're much more sensitive to how the Chinese economy performs than how the U.S. economy performs. Now, they don't do too much trade with the Eurozone as a whole, but the problems in Europe will affect global demand and will affect demand for Chinese goods, and also will affect the asset markets or the stock markets in general. And what that does is it filters down into the Australian economy by affecting how the Australian stock markets trade, as well as how the Australian dollar trades. Because as you see today, the risk aversion move has dragged the Australian dollar lower, which actually is good for Australia. But if we have kind of the asset markets rally, we could see Australian dollar rally, which may not be as good. So China is an extremely important partner for Australia. In fact, they are so important that we can even say that China has Australia in their pocket, because Australia basically relies so heavily on Chinese demand that that Australian-Chinese relations is a very top priority for Julia Gillard's government. And I would even venture to say that much of monetary policy in Australia is tied to how the Chinese economy performs. And this chart that I'll show you next, these two charts I'll show you next, kind of explains the reason why. And take a look here. You see that China is Australia's largest trading partner. Between 1990 and 2012, exports to the U.S. have pretty much flatlined with a very slight turn upwards. Exports to China, on the other hand, has exploded. So what this has done is that it has made Australian and Chinese GDP very correlated. So what you're seeing in this chart here is the year-over-year growth in the year-over-year GDP rate for Australia, as well as the year-over-year GDP rate for China. The white line on this chart is the year-over-year rate for Australia, and the yellow line on this chart is the annualized GDP rate for China. And what I want to draw to your attention is that oftentimes the yellow line will lead the white line, which basically means that the Chinese economy and Chinese growth is leading the Australian economy and Australian growth. So this is kind of important because if you take a look at this chart here in 2009, we had a nice little explosion in Chinese growth. That led to a nice little explosion in Australian growth. Then we started to top out in the Chinese economy pretty much in the beginning of 2010. And the Australian economy didn't top out until the first quarter of 2010. But since then, the Chinese economy has only the GDP growth has only gotten slower and slower. Basically, at the beginning of 2010, the Chinese economy was expanding at an annualized rate of 12%, and the latest GDP report we had from China showed growth spanning only about 8.1%. You can't see that clearly here, but the white line actually ends 1 quarter before the yellow line. So the latest GDP number that we actually have from Australia is basically from the fourth quarter, I believe. And let me just pull up the number, show you exactly where that is, which is over here. In the fourth quarter, the Australian economy grew a mere 2.3%. So given that you take a look at this chart, going all the way back to 2000, the strong correlation between Australian and Chinese growth, this tells you that there's a very good chance that this white line is going to come down towards this yellow line. We may not see it dip below 2% as this chart would suggest, but there is a good chance that we could see, slower GDP growth in the first quarter, maybe even down to, 2.2 or 2.1% for Australia. So this explains why Australia really looks up to China in terms of the economy, because that's really determines how the Australian economy will fare, and then it determines how the Reserve Bank will act. So when it comes to trading the Australian dollar, we don't have as much market moving economic data as we do in the Eurozone, for example, or we do in the U.S. So in the Eurozone, we have a lot of economic data that we follow. For example, the German IFO report, the German Zoo survey, things like that. In Australia, these are the only economic data that matters, and these are the only ones that really cause volatility in the Australian dollar. And they're the only ones that the RBA really looks at. So starting off, employment numbers are very important because job growth is the backbone of the economy. It's the backbone of any economy, including the Australian economy. If we have a lot of job growth, that's going to bode extremely well for Australia. If we have, a deterioration in the labor market, that's going to make the RBA more apt to cut interest rates. Now, the Australian unemployment rate is obviously much lower than the U.S. unemployment rate, but it has ticked upwards in recent months, and that's somewhat worrisome to the Australian government. The RBA also focuses very heavily on inflation. So last night we had horrid producer price figures. Producer prices fell by, I think it was let me double check. Let me look at my calendar real quick. Australian producer prices fell by 0.3%. So given that it fell by 0.3%, that means that inflationary pressures have eased, and that explains why the Aussie dollar is off, 0.75% today. Service and manufacturing activity is also very important. Australia doesn't really produce like industrial production or factories orders like some of the other countries. So service and manufacturing activity is kind of the most up-to-date information that we will get in terms of how the economy is doing. Also, the service sector PMI numbers oftentimes released before retail sales, so it's a leading indicator for retail sales. So I would even venture to say that the service and PMI numbers for Australia may even be more market moving than the Australian retail sales numbers. And then finally, GDP. GDP is always important, but GDP can be somewhat backwards looking, so it may not be as market moving as some of these other numbers here. Nonetheless, these are the eco data pieces that matter, and of course, the one thing that we do not have on this list is Reserve Bank of Australia rate decision, and we'll discuss that in slightly further detail in just a moment. When it comes to trading the Australian dollar, it is also very important to pay attention to two things, which is the price of gold and the price of oil. Now, if you take a look at this chart, you can see that the Aussie dollar and gold has had a very, very strong relationship that has gone all the way back to the 90s. This chart only shows you since 2008, but it's been a very, very nice relationship between these two instruments. In 2011, we did see a little bit of a breakdown in this relationship. The orange line is the Aussie dollar, the white line is gold prices, and the breakdown that we saw in 2008 was when we had this drop in the Australian dollar, and yet we had the gold prices continue to push higher to a record high. And the reason why gold can rise and the Aussie dollar will fall is because gold is, known as the ultimate form of safety, whereas the Aussie dollar is a risk currency. So there could be cases where, people will snap up gold but sell Australian dollars because they're, not so confident in the global economy, but they're very confident in, non-paper currencies such as gold. There's also a very strong relationship between the price of the Aussie dollar and copper. The white line in this chart is the Aussie dollar, and the green line on this chart is copper. And you can see that the correlation is also, lasted since 2010. And, we tend to have larger moves in copper than we have in the Australian dollar. But copper is actually a much more important export to Australia than gold. And so, there seems to be good correlation between copper and, the Aussie dollar price. But Aussie dollar also has a very strong correlation with gold prices. Nonetheless, it's important to keep and pay attention to both because the Aussie dollar will trail both of these commodities. Because at the end of the day, the Australian dollar is known as a commodity currency because they are such a large producer of commodities. So because they're known as a commodity currency, they will be very sensitive to the movements of commodity prices. But the movements of commodity prices is not as important as the risk appetite in the market and how that impacts the Australian dollar. So with that, let's take a look at how the Australian economy has performed as of late, because that will help us understand what the central bank could do. So I've got, an economic calendar here, and I'm going to refresh my screen so you can see the calendar, refresh my camera, and feel free to type questions because I've got my question box up again. So I've already sorted this calendar here for Australian data, going all the way back from the last RBA meeting to present. And what you will see is that, the retail sales release from the month of February showed consumer spending growth basically slowing. We also had a little bit of uptick in the March service sector PMI numbers. We'll see if there's any more recent numbers after that. Unfortunately, Australia reported another trade deficit in the month of February. We had business confidence hold steady, business conditions improved slightly, consumer confidence remains negative, home loans deteriorated. The unemployment rate, remains unchanged at 5.2%. We actually had a very good month for the Australian labour market in the month of March. So that could be a reason why the RBA could delay a rate hike. Basically, the next RBA meeting, let me just get the exact date of the next RBA meeting. The next RBA meeting will be on June 5th. So depending upon how data fares between now and then, because we should get another unemployment report, the next RBA meeting is May 1st. So between now and then, we will see how the employment numbers fare. There's a possibility that the RBA could hold off on cutting interest rates in May if the next unemployment number, is not that weak. But in terms of the latest unemployment number we've had, it's pretty good. And so there's evidence of slower inflationary pressures, but the RBA may want to see a weaker employment report before taking action to ease monetary policy. Business confidence from the National Bank of Australia was somewhat weaker, so that kind of, would give them an indication to cut rates. One of the major reasons and the major arguments for lower interest rates in Australia is that we've got slower growth in China. Economic data from China has been slowing. They're looking to basically appreciate their currency, which could slow demand for Chinese exports. So since we talked about how much Australia relies on the Chinese economy, that provides a pretty solid argument for why the RBA may want to ease, even though domestically the labor market may not be faring as poorly. Now, inflationary pressures, however, have eased quite a bit. Import and export prices both fell in the first quarter. Last night, we had the producer price figures, and we already talked about how they basically fell 0.3%. And this was a surprise decline. It was also the first decline in producer prices since the fourth quarter of 2009. So with regards to inflation, usually when we have softer inflationary pressures in an environment where growth is kind of, not doing so well, that usually gives the RBA some confidence to cut interest rates, or it gives them the flexibility at least to ease monetary policy. Because one of the greatest fears that central banks have when it comes to cutting interest rates is that their rate cut could stoke inflationary pressures. With the RBA, on the other hand, since we have producer prices fall, they wouldn't be as worried about the rate cut, causing inflationary pressures because inflationary pressures are lower. So we got a little question here that basically says, how does the fact that RBA lowers interest rates but the commercial banks raise their affect demand for the Aussie? Well, if that was the case, that would kind of, maintain demand for the Aussie. But more importantly, it would maintain demand for the Australian dollar as a carry currency, because it basically says that, interest rates are not necessarily going to, it basically says that interest rates are not necessarily going to, deter investors from investing in Australian dollar from a yield perspective. Okay, so taking a look at what the RBA has been saying recently, because that is going to help us understand why the Aussie dollar has been falling so much and why, monetary easing is on the agenda. And just give me 1 second. I apologize for my screen flashing back and forth. Let me see if I can do anything about that. I'll minimize. So when the RBA last met back in early April, they were relatively dovish, and the minutes that were released last week kind of confirmed that. What RBA Governor Glenn Stevens said was that the economy is not growing as expected. The growth in China is likely to remain at a more measured and sustainable pace in the future, meaning that it's not going to grow as fast as they previously anticipated. And more importantly, output was lower than estimated, so they need to see price data before considering additional steps to ease monetary policy. Even though they qualified this, what they did say was that, let me refresh this. What they did say was that, they said they could introduce the words ease monetary policy. And that got people thinking about the possibility of, a rate cut. So then the RBA minutes came out last week and kind of reinforced their dovishness. And then we had the drop in PPI last night. So if we have the drop in CPI tonight, then, that could really prompt the Reserve Bank to take action. So we've got, on one hand, domestic conditions are not so good, but that's only really in the labor market report. If we listen very carefully to what the RBA said, and, listen to their hint that if inflation falls, they'd be ready to cut, that, that would tell us that, if the CPI numbers are soft, they could very well cut interest rates on May 1st. So that explains why the Aussie dollar has been performing so softly, and it kind of explains why the Australian dollar has essentially fallen from, a high of, 104.50 at the beginning of the month to, breaking below 103 and maybe even going towards 102. So if the CPI number is soft, we could, quite potentially see further gains, because that would build the odds for RBA rate hike in just a week or so. But there is a small reason why the RBA want to hold, so a rate cut is not a done deal. What all of this tells you is that if there's only one thing you take away from everything that I've talked about today, that should be that fundamentals matter. So it's very important to pay attention to fundamental developments, because they will play a very big role in how the currencies trade. And I talk about fundamental developments all the time. You can follow me at Kathy Lien FX on Twitter, and I just want to show you real quick how I tweeted about the Australian dollar and what I expected for the RBA rate decision last night, for those of you that are on Twitter. And usually I'm quite active on there. And you'll see that, throughout the night I talked about how Australian PPI numbers were soft and talked a little bit about the Chinese manufacturing numbers. So I'm tweeting throughout the course of the day. If you don't follow me already on Twitter, I encourage you to do so. At Kathy Lien FX is my handle for Twitter. The key to trading well is combining fundamentals with technicals. So with that, I want to share with you a little Australian dollar trading strategy. So let me just go to my chart for a second. And let me refresh my screen. So this is a 15-minute chart of the Australian dollar. And this strategy is quite simple. It's more something I want to call your attention to. And it's basically the 50 trade. It's what we call the 50 00 trade in the Australian dollar. And let me just minimize my screens for 1 second. And what we found is that if the Australian dollar moves from the figure over to 50, there's a very good chance that there's going to be continuation. So one of the ways you can trade that is to watch certain levels in the Australian dollar. So I'm just going to tell you some levels to watch. Basically, we're going to watch the figure level, the 50 level, and I'm going to show you a little how the currency has traded these levels over the past couple of days. And so what we do with the Aussie dollar is that we look for it to basically trade from, and let me see if I can get a slightly 20-minute chart, which will provide me with slightly more data. Okay, so what we're looking for is if the Aussie dollar is trading from the round number, so let's look for a period when it's trading from the round number, so right around here it is. So if it's trading for 104 and it basically declines all the way to 50, that's when we would go short. So the first rule of this is you want to look for, in a short trade, Aussie dollar to have traded at in this case 1.400 within the past, I would say, 6 hours. If that's the case, then you want to place a order to sell at 50, so in this case 103.50. So we would have been entered the trade somewhere around this level here with the stop at 104. So 50 pips stop. And then what you could do is you could target the round number, which would be on the other side, which would be 103. So in this case, you see that we went short the Aussie dollar at 104.50. Let me see if I can add a horizontal line here. With a stop at 104, so it never went up to stop at 104, targeting 103. And you could see that we would have entered this trade around this time, would have nursed it for over the weekend, and would have closed the trade over at 103 earlier this morning. Let's see our next trading opportunity here. Our next trading opportunity is actually on the long side. Now, I would say that this is close enough for you to take the trade, because in this case, the Aussie dollar traded pretty much at as low as 103.04, which is just a few pips shy of 103. So it's good enough for a trade. So in this case, we would have look for the Aussie dollar for a long trade. Look for Aussie dollar to trade at 103. Then you want to wait for it to rally to 103.50. So we wait for it to rally to 103.50. So we would have gone long here with a stop back at 103, targeting 104. And in this case, just a couple of hours later it hits 104. This is you know, part of what we call high probability FX trading, which is why we use one-to-one risk reward. If you're not familiar with it, you know, maybe I'll hold a special session on it in the future. But for those of you that attended many of these sessions, you probably realize that, you know, Boris and I are big believers of high probability and not high profit trading. So we don't believe in 2-to-1 risk reward. We look for high accuracy, and so we go sometimes for 1-to-1 risk reward. So that was another trade there, which is right around here. Let's see if we can find the next trade. So the next trade would be, let me just, over here, 104. So 104, you go short at 103.50, and then, you know, pretty much the same thing. I think I just showed you this trade. And then let's go to the next long trade. We're just flipping back on the chart. So the next trade would be a long trade over here, where the currency basically touched 103, and then a rally to 103.50. That's where you go long. So you go long at 103.50, a stop back at 103, targeting 104 in the Aussie dollar, and you can see that was also hit a couple hours later. So you can keep on going back in your chart, and you can see, you know, it won't work 100% of the time, but it's a pretty efficient strategy. Basically, you know, buying and selling and keying off the 50 mark, because the Aussie dollar, and the reason why, you know, we like this so much is because the Aussie dollar tends to be a very trending currency. So whenever it gets going, you know, there's a good chance that we may have some good degree of continuation in the currency pair. So with that, I just want to wrap up with a couple things real quick. Let me go back to my slides. Let me refresh my trading screen. If you have any questions about the strategy, you can always, you know, email me at Kathy at BKForexAdvisors.com. Sorry, let me flip back on my slides. And I want to just spend a couple minutes telling you a little bit about what we do at BKForex.com. At BKForex, we provide trading signals. We offer 3 types of trading signals. They're all included in a package. We offer 1 to 2 flow trades a day. Today we caught a really nice profitable euro short trade, and we caught the move down towards the figure in the euro dollar. You know, obviously past performance is not indicative of future results, but we provide 1 to 2, you know, intraday trading strategies. We also provide 1 to 2 swing trades a week, and every single day we provide indications of how we expect economic data to fare, which are basically our calendar calls, and that's all included in your BK subscription. So we're focused on giving you, you know, trading signals. We are a CTA with NFA audited results. You can go on our track record. You can see, you know, how we performed since 2008. We've never had a losing year. Once again, you know, that doesn't mean past performance is, you know, not indicative of future results, but, you know, we have done fairly well, and the NFA has audited our results. When we trade, we send you, you know, different types of trading signals to your cell phone, and we, you know, kind of hold your hands throughout the period. Every trading signal comes with fundamental and technical reasoning, so we explain to you why we take the trade from a fundamental and technical basis. And, you know, every single trade does use fundamentals and technicals as a part of the methodology, and that's really our edge when it comes to trading currencies. We've done really well with our swing trades. This is kind of track record since the end of January, beginning of February. As you can see, we've had about, you know, 10 out of 12 winners in our last couple of trades. So, you know, we are pretty happy with our performance. So we hope that you'll give it a look. And then every trade comes with like I said, what we're trading, why we're trading, stops and limits, and updates along the way. And we have a private Twitter feed for our subscribers where everything is posted and, you know, kind of different information is provided. And we're now offering $59 1-week trial. So if you're interested in getting a taste of our service, you can do so for a relatively, you know, affordable rate. And if you want more information, like I said, you know, please visit BKForex.com, and, you know, all of the information is provided there. So with that, I want to open up the floor to any questions. Let's see. what is the key fundamental support for the Australian dollar? If we just go back, I'll pull up this Australian dollar chart, and let me just flip back to the current prices. Give me 1 second, I'll update my chart. Okay, so I've got a chart here of the daily chart of the Aussie dollar, and let me just refresh my screen. Alright, so we've got a nice little daily chart here of the Aussie dollar, and support, first of all, let me move my line. The first level of support is going to be at a level that's actually coming up close, and that's going to be the year-to-date lows of around 102.25. So that's pretty much going to come in as the first level of support. There's also a Bollinger Band there. Let me just show you my Bollinger Band. And just ignore the different colors, but for illustration purposes, I want to show you that not only is it the year-to-date lows, but it's also second standard deviation Bollinger Band. So that should be the fundamental. That should be the next area of support for the Aussie dollar. I'm not too sure whether this webinar is recorded. You have to ask FX Street for that. Do you think the Aussie will range until there's significant data? I actually think that the Aussie dollar is going to head lower as it closer and closer to the rate decision. It won't take long for the RBA to meet on May 1st, so we could see a bit more of a trending move in the Aussie dollar rather than a ranged move. Do I plan to have a webinar series on the other currencies? Haven't thought about it quite yet, Kiwi, but you'll find out if I do. I have a webinar every single month, Pip Caesar, so that's kind of I'm on a month schedule, but we'll probably do one for each of the major currencies. Do I see parity for Aussie dollar by May 2012? It's possible. I am looking for the Aussie dollar to move lower. Whether or not it gets to parity will depend upon whether the RBA says that their rate cut is a one-off cut or the beginning of a series of additional cuts. Where do we look for fundamental news? Because the market's always moving, even when the data's come out. So, like I said, most brokers offer a real-time news feed, but Twitter is really the place to be these days. So I'm publishing real-time news. FX Street publishes real-time kind of commentary on Twitter as well. It's really the place to be. So you can look at who I follow on Twitter and follow them because that's where I look at my information as well. So, any other questions? The Kiwi dollar, similar to Aussie dollar, but it's got its own nuances and, is not completely identical to trading. Trading in Aussie is not the same as trading Kiwi. So just some things for you. Once again, my Twitter handle is Kathy Lien FX. My email, if you have any questions, is going to be Kathy@BKForexAdvisors.com, and then BKForex.com is our website for the $59 trial. If they reduce interest rates, Pip Caesar, it's probably going to be bearish for the Australian dollar, but we'll also have to listen to what they say because it really depends upon whether or not they say it's a one-off move. But I think going into the rate decision, we'll probably see the Aussie dollar decline. Okay, so I think my time is up, and I want to thank you all. You'll find all the information on the websites that I've linked there. And if you have any questions, please drop me an email.